Let's talk about a company's statement of financial position, also known as the balance sheet. Get it? The balance sheet is a snapshot of a company. Think of it like the description you'd write on a dating profile if it had to be legally accurate. Like, I'm only 1.5 meters tall and I hate long walks on the beach. Balance sheets are typically separated into two sides, with assets on the left and liabilities on the right. The way I remember this is that you gotta use what assets you got left to pay your liabilities so you can get right. Huh? Get it? Assets are the stuff you have, including current assets, like cash or things that can be converted into cash within 1 year. Then there's long-term assets, like property, plant, and equipment. For these items, we use the book value, which is the cost you paid for them minus their accumulated depreciation. The best way to remember book value is think of books. You can either buy them full price new, but after they've been used, they cost less because people's fingers are disgusting. On the right side of the balance sheet, we have liabilities. Current liabilities are those which you need to pay within 1 year, or else. Then there's long-term liabilities, like debt, capital leases, or deferred taxes, which, if you need more information on not paying your taxes, just ask my president. A good key term to know is net working capital. This is current assets minus current liabilities. A good way to remember net working capital is if you don't have any net working capital, nobody wants to be networking with you. Now, if you take all the assets you have and subtract all the liabilities you owe, you have your company's net worth, also known as stockholders' equity. Yeah, you can call it that. People are like, what's your net worth? I'm like, oh, my stockholders' equity? $2. Thus, we have the equation assets equals liabilities plus stockholders' equity. This is called the balance sheet identity. It's very simple, so if you're too dumb to remember it, it's because your brain's a liability. But if you take stock of this knowledge and add it to that liability, your brain becomes an asset. Get it? Note that in this equation, we're using the book value of equity. The market value of equity is equal to the number of shares outstanding times the market price per share. This is also called market capitalization, or market cap, or just nod if you can communicate telepathically. The market to book ratio is the market capitalization divided by the book value of equity. For most successful companies, this is greater than 1, which makes sense because if your book value is higher than what the market rates you as, you're, how can I say this? Companies with high ratios have what we call growth stock. Companies with low ratios have what we call value stocks. It's a very nice way of putting it. Last thing, total enterprise value equals the market value of equity plus debt minus cash. It's basically thought of as the takeover price of a company. So if anybody ever asks you, what's your enterprise value? They're basically asking, how much to own you? Thank you! And now you understand the balance sheet. Still get it?